Joining us now, Peter Boockvar, Chief Investment Officer at Bleakley Advisory Group. Peter, great to speak with you this afternoon.
Hi, Morgan. Thanks for having me.
So what do you think about the rally we've seen in the last 2 days? Is this a dead cat bounce, as I've been asking guests throughout the last 2 hours, or is this rally for real here?
So the context for yesterday's rally off the low was a market that was very oversold, sentiment that was getting very dour by looking at the investors' intelligence numbers, where bears are almost exceeding bulls, the AAI number that came out on Thursday, where bears were above 50. So we were looking for some sort of flush out, and we certainly got it. But to me, it's just temporary. The biggest risk is not Putin. It's Jay Powell. It's Christine Lagarde. It's Bailey in the UK. To the extent of we have this synchronized monetary tightening that we're really just entering the teeth of.
So if we have this synchronized monetary tightening, I mean, you and I have had these conversations about inflation for, oh my gosh, almost a year and a half now. You were really very early to the game in terms of identifying it and getting concerned about it. Tightening would be a good thing to get that in control, no?
Yes. So over time, no question. We need low inflation to have sustainable, healthy growth and maximum employment. And of course, that was turned around. But yes, over time, we need to get out of this low rate trap that we're in. Unfortunately, you can't do that in a painless way. And there is an adjustment period that needs to take place until you get from here to there. The one problem with the Fed's ability to deal with inflation is if you look at the last 40 years, every tightening cycle ended at a rate below the previous peak of the tightening cycle, which implies that the Fed is maybe going to get the Fed funds rate to 1.5% to 2% before something breaks. The problem is something may break while inflation is still very high, which would create a real problem for them.
Peter, this is Courtney. There's not a whole lot that the Fed can really do when it comes to tools in its toolbox to get a handle on inflation. We all believe we're looking at a number of rate hikes. How many and to what degree, I guess, is still a question mark. Do you think that the Fed can get a handle on inflation by just moving rates? Do they need to start with 50 basis points right away?
It is a great question. I think if I was there, I would go with the 50. I mean, we're at 0. So going from 0 to 50 when inflation's at 7.5% shouldn't be perceived as something bold. It should be seen as something prudent. But this is a committee that does things very methodically and are more afraid of slowing growth than slowing inflation. And they even talked that we had a couple of Fed members even yesterday hinting that, well, if the geopolitical situation gets out of control, maybe we need to slow down. So they're already sort of reacting to the possibility of an economic slowdown rather than saying we need to attack inflation. The problem in all this is that markets are intertwined to this analysis. It's not just monetary policy in the economy, because monetary policy has a direct impact in the markets. And if the markets really roll over, that will then directly impact the economy, create tightening financial conditions, and create sort of a double problem with the economy and markets.
So how do you play this market right now? Where do you position yourself as an investor?
So I'm still very bullish on the commodity trade. I know we've had a nice move already, but I still think there's going to be a lot of upside that the Russia-Ukraine situation just further exacerbates. I'm still very bullish on gold and silver. I still like Asian markets more so than U.S. markets on a valuation perspective. And also when you look at over the next 10 years where I think the best growth will be, and it's going to be there. And in fixed income, I actually like local currency emerging market bonds. It's one of the few places where you can get yield with, I think, reduced credit risk and the potential of some dollar weakness that will then enhance your return.